Why would I have gone against what I just said I would do about fighting for every nickel and dime and close these two early? Well, the 80-20 rule comes into play, but even this one I might consider closing early for a profit. And the reason why is because of what we looked at just a moment ago at the beginning of the presentation. Back on the main homepage, have we updated? No, we haven't. We're still at June 13. But we've been holding these sell warnings. And the market eased off a little bit today. It went down in the beginning, came back up. I think the VIX was as high as 1297, I think is what I saw today. Let's take a look at what the high was today. That was the open range. Oh, no, it went to 1340. I must have missed that right at the open, but it went up to 1345 from 1194 just the other day. On Thursday, the low was 1194 to 1222. But yeah, 1212 to 1345, settling back down at 1266. So there's some volatility out there. There's some hesitation, but we've been seeing these sell warnings come up. Let's go to view overall sentiment history here. And we've been in a sell warning range for the past few days. The reason why, this one here is neutral is because we did end up with 1 bullish, but only 4 bearish. Now we're back to 5 bearish, 7 neutral, and 1 bullish. That puts us back in the sell warnings. We didn't have a bullish indicator for the last few days. I was waiting to see this if it triggered, if the market kept being strong, and as you can tell, it has been, waiting to see this go into that bearish, strong bearish sell warning. When another bearish goes or the bullish goes, the bullish disappears, goes to 0, and the bearish goes up to 6 maybe. That could be a concern. It's going into the darker red. Let's see if we've had, yeah, there it is. The strong bearish sell warning, 7 and 4. 6 and 7 isn't quite one yet. It's still a sell warning, but 7 and 6 here, that was a strong bearish sell warning. So yes, the market's been hot. We've seen some of the inflation numbers come in. We heard the discussion from Powell and the Fed over the week about how only expect 1 rate cut potentially now in 2024 based on how things are going. Home prices still extraordinarily high, and the inflation rate on that, interest rate on that is still very high, but everything else is starting to cool a little bit, but it's not cooling enough, of course, for Powell and the Fed. So no cuts yet, but only expecting maybe 1. But this is probably going to update in the next 2 or 3 minutes. When I start seeing the bearish sell warnings go, and I've got bull put credit spreads, excuse me, folks, in my portfolio that have already hit 90, 80, 85% of the expected profit, 7 days to go, I'm going to lighten those up. I'm going to take that profit. I'm not going to risk seeing a strong bearish sell warnings appear and start to worry about, in that case, hey, am I going to have to manage these positions? Am I going to have to adjust these positions? I'd rather take the profit now, not worry about it, but watch that third position on First Solar like a hawk, because it's only at 57%. I probably want to hold that a little bit longer. But yeah, I could probably be talked into closing that at 57, 60% of the expected max profit in that case if the sell warnings continue to increase. A thought did come in that I was going to address if we had the time. Looks like we have the time because no other questions came in. Let's go back to Alfonso's portfolio. I don't want to say Alfonso's portfolio because these are not the positions that he opened. But back to the bull call debits. A comment came in and said, well, couldn't you adjust the losing debit spread to make it into a profit? Now, as you know, we have the various videos and we have the various playlists on Power Options YouTube channel, of course, and on the playlist, one of the ones there is Bull Call Debit Spreads, Tools, Structure, and Criteria. And if you click on View Full Playlist, you'll see the various ones: tools for evaluating credit and debit spreads, how to use the search tools, sample searches, preferred criteria, just a basic review. In the money debit spreads, that higher probability, lower return. The in the money versus out of the money bull call debit spreads. Bull call debit or bull put credit, which do you prefer? What are the pros and the cons? Always a good one when comparing parity trades if they're at the same strike, but there's different ways to structure them. Okay, stops on debit spreads, and 7 ways to manage a bull call debit spread that's going against you. And of course, rolling a successful, as I mentioned, debit spread, there's ways you can adjust that position to lock in some profit and get more. Now, the 7 ways to manage a debit spread. There's 8 ways that I choose to manage. Oh, sorry, wrong position. I'm sorry. There we go. There's 8 ways that we use to manage a credit spread. One of those is lost in the debit spread. And the one that's lost in the debit spread, let's go to our profit and loss chart here. Here's NCLH, stock at 1656. Drop below our sold call. It's right at our bought call one, almost near, not near full loss now, but we saw that it would be at an 82, 83% loss. We held it all the way to expiration, and Norwegian Cruise Line stayed at the same position. Current price, excuse me. Now, in a credit spread, a bull put credit spread. Now we're looking at a bull call debit spread, I know, but in a bull put credit spread, which has a similar risk reward profile, if the stock starts to move against me and starts to get to my pivot, my short call or short put strike price in the case of a bull put credit spread, one technique I may use is to just buy to close the short call, even though it's more expensive and it's going to put me in a debit, because whatever news came out about the trade, if I still have 7, 5, 6, 7, 10 days left to expiration on that 14-day, 11-day trade I opened, sudden news came out and the stock fell to my short put strike price, or within 1%, as you know, if you follow my webinars, that's one of the management techniques, alerts, I should say. But I might buy to close the put and leave the long put open. So now as the stock continues to drop, hopefully the value I get on just my long put position counters the debit. That's the method that you can't use in a debit spread, because these are calls. If the stock's falling, this is losing value, not gaining value as it is in a bull put. This is losing value in your favor. That's good. I could buy to close this short call here for a profit, but I'm losing more on the long call in this case, and that's where the loss is. Now that the stock is between the strike prices, it's a little bit too close to this long one here. I prefer to try a pendulum adjustment, honestly, Jim. Now, a pendulum adjustment, we use it in credit spreads, and you can use it in a debit spread as well. We opened NCLH when the stock was at around 1780, I think, maybe 18 last week on the 7th. Let's take a look. So I'm not just throwing out numbers there. I want to make sure I'm correct at where the stock price was when this position came up on the search for Alfonso's goals and requirements. So last week on the 7th, yeah, we were at 1780.18 roughly. It was about 1780, I think. And it moved up, and then today it took a big jump down. Not sure why, don't know what was in the news, but yeah, it dropped back down. We're at 1660. Okay. I'll just close those out there, sorry. All right. So what's happening here? Our stock that we were bullish on had the return that we wanted, met that criteria, is now going against us. The stock's going bearish, and we're in a bullish spread. The pendulum adjustment, and I use this potentially in a bull put credit spread as well, we're going to leave, if the mathematics work out correctly, we're going to leave the sold option open. The sold call, our 17 strike, that's now out of the money, or would be the 17 put, which is in the money. And what we're going to do is buy to close, sell to close, my apologies, the long option, and swing it out to the 1750. We're going to keep the same 50-cent strike difference in this case. We're going to swing this out, and if the math makes sense, we're going to convert here our bull call debit into a bear call credit with one move. So now the bear call credit, we've sold the 17 strike and bought the 1750. And we're going to end up with something hopefully that looks like this. It's going to be a much lower profit if we get the right prices. It probably would increase the risk to the upside if it rebounds, but that's the pendulum. We're going to swing the long option out to create the opposite vertical spread. We're going to move from a bull call debit to a bear call credit. Now, this is too close to that long call strike price, so I don't think this is going to work, but we're going to try it anyway. What am I doing? I'm going to sell to close the 1650 call. We're going to lose money on it. And then I'm going to buy a higher strike, 17.5 strike call. That's the pendulum adjustment. So our June expiration, calls have already been added. I'm going to click this again because I want to add in the 1650 call to show that we're selling to close it. Now that just by itself, let's look at the math here. We're only going to get about 40 cents for it. Let's keep the math simple. Let's just get 40 cents for it. So we lost about 95 cents on that 16.5 strike call. Of course, that leaves us with a naked call. Ooh, sorry, leaves us with a naked call of a credit of only 6 cents. Oh, that's going to be tough. So let's go now. June expiration. What does that mean? That means in order to achieve any credit to have any profit, our 1750 call has to be less than 6 cents, and it's not. So it would be a guaranteed loss, but a guaranteed loss if the stock stays below 17 of only 1 cent. Let's just buy one. And so, yeah, we're down about $1.50. So it's better than the loss we're taking right now in the bull call debit spread of, what was that? I apologize. Oh, no, that's not what I wanted. Sorry, folks. There it is. Of $12. But it didn't solve the problem. Let's go to the higher strike. Let's go to the full dollar strike difference on the pendulum adjustment here. It looked like it was only 3 or 4 cents for June 21st. And the 18 strike. Now, this would result in a profit, but what's the problem? So now we could make $2.50. 2 cents if the stock stays below the 17 or the 18. I'm sorry, still the 17 strike. We kept the short in play. But now your risk is up to 147.50 to make 250. I mean, we're at, what is that, almost a 20-to-1 risk reward ratio, a 7-to-1 risk reward ratio. No, it's way more than that. I apologize. No, it's about that. So yeah, only a 1.7% return, which is better than a 12-cent loss. I get it. But usually this works best if a sudden move happens and the stock's trading right between your strike prices. That's the best time to use the pendulum adjustment. Now, could we just do the obvious and close this spread for a loss now and roll it down to lower strikes, say a 15.50, 15, 3 weeks out in time? Sure. But what's going on here? The stock that we were bullish on when it was trading at about 1750, 1760, 1780, when we opened this position, has now turned bearish. I always talk about this. Yes, it's one of the 7 ways to manage a bull called debit spread. Just close the spread and roll down. You're always going to increase your risk in that situation. You either have to increase the number of strikes or you have to increase the width to make back the loss that you took, and you have to go further out in time. You might have to do all 3 of those. So you're increasing the risk drastically on a stock that has shown you it's not what you expected. I might close this spread and do the opposite, do a bear put debit or a bear call 3 weeks out in time to make up the loss rather than just doing the pendulum. That's true. But when you're in a position, I know a lot of gurus out there and a lot of other educators like myself talk about it. Oh, you don't have to worry about the vertical spread. Just close it and move it down and further out in time to lower strikes and you'll be fine. It's already shown you it's not the stock you want for that strategy. You're most likely want to close and do the opposite. Could I convert this to a debit condor, of course, for a better break even or potentially even a butterfly? Yeah, absolutely. With the prices as they are now, if I converted to an all call butterfly, we could sell the 17 call again and get 17, 18 cents. And let's keep the math simple. We're just going to get an extra 10 cents of premium here. So what am I doing? I'm entering essentially that bear call credit spread I mentioned, but not doing the pendulum adjustment. I'm adding a bear call credit spread for a little bit of premium, about 11 cents. So the idea is to increase the break even, but I'm already still in the loss zone. Doesn't repair the position. The condor wouldn't either because we'd be taking less premium. Yeah, we did give ourselves a better lower break even, and now we have an upper break even, but the stock's still trading below both. So that's not really a solution here, and the condor would give us less premium, so we wouldn't see that. So in this scenario, because the stock's shown me that it's more bearish now. Let's look at the chart again. My apologies, folks. What do I tend to look for? And everyone has their own way of voodoo and hoodoo. The stock is now below the 20-day moving average, not something I do for a bullish vertical spread. The MACD has not gone negative yet, but is really about to. Okay, those are my criteria for a bull put or bull call. I look for something that has had a positive MACD, for at least the past 3 or 4 days is trading above the 20-day moving average. Maybe this didn't. Oh, it did have a little Bollinger breakout there, but it's just diving now. And the MACD is looking to go negative. This is giving me all the warning signs. And yeah, I didn't have a chance perhaps today to close this. It looked like it opened up here still in, but started to go down during the day. So I would have closed this when it got within 1% of my short call strike price. That alerts would have triggered. And as soon as the stock fell below the SMA 20, my alerts would have triggered as well to say, hey, Mike, you need to pay attention. Something's going wrong here with NLCH bull call debit spread or bull put credit spread. You need to look at some management, evaluate some rollout opportunities, decide what you want to do. Now that it's at the end of the day and it's happened, sometimes it's better just to close, take the loss, and move on. So I'm only at a 35.3% loss. I'm not at the 50% loss, but everything else, I'm below my strike price of my sold option. SMA stocks below the SMA 20, one of the criteria I would have used to enter the bullish trade. The MACD is just about negative. So I'm not at 50% loss yet of the maximum worst scenario that I could lose in this case. But I'm right in the wheelhouse, and the other things are screaming at me to say get out of the position. And still remained a sell warning, but we're 6, 6, and 1. So one of them moved out of neutral, moved to bearish, but the bullish one is still remaining. What is this bullish? What is the trend? It's the trend. Okay, the trend's still holding, and that's all is the trend. The trend's still holding in bullish. The VIX has gone back into bearish mode. Put call volume ratios in the bearish fence. RSI of SPX, number of days over the SMA 20, number of the days, strong market, SPX MACD gap. They're showing us the bearish warnings. But we haven't gone into that bearish sell yet, but yeah, I'm hesitant enough to say that I'd likely be closing that position, I think, just like I'd be closing the bull put credit spreads that we had that were profitable if we opened them from that search list last week.